Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Levitt of Invesco joining the chorus of warnings, writing this: for the first time in a year, we favour a more defensive posture in the near term. That does not mean that we eliminate equities from the portfolio, but rather shift towards higher quality. Brian joins us for more. Brian, good morning to you.
Good morning.
Before we get into what you're doing beneath the surface, this is a big change for you. Typically, you come on the programme, you sort of push all the bears aside and you say, I want to be part of this market. What's changed for you?
Well, the first thing I want to say is I still believe over the intermediate term we want to be in equities. I still come back to peak inflation, peak rates, peak tightening is favorable for equities over the intermediate term time period. What we're looking at is more of a tactical indicator that says, look, the global economy is growing below trend and it looks like things are starting to soften. So when you're below trend and things are weakening, you want to be more defensive in the portfolio. And some of that global weakness is being led by the United States. Things are slowing. It's not a recession call. It's not, something ominous is coming, but rather tactically, things are slowing down and we're still waiting on the Fed to respond.
That's the change, and I think that's the important distinction. We've been talking about global growth ex-US below trend for quite a while now. The new ingredients is the US slowing down.
US is slowing.
Something we've been talking about is at what point does someone like you become more concerned about what slowdown? That it's not just slowing, right. That it's slow.
That it's slow and that you may in fact have a recession. The good news is that we don't have a lot of excess in this economy. If you look at residential investment as a percent of GDP, if you look at inventory to sales ratios, this isn't an economy that's dealing with a lot of excess. We don't have businesses that are over levered, banks that are sitting on piles of bad loans. And you see it in the corporate bond market. Corporate bond market isn't worried about this economy as of yet at all. Instead, what you're seeing is weakness, slowdown, which by the way is what the Federal Reserve wanted. It's here. The challenge is we've got a 5.25%, 5.5% Fed funds target. And yet the economy is slowing and inflation's in the comfort zone. So it's not a perfect backdrop for equities over the next few months.
You say go into quality, yeah. And I wonder how quality has changed, given the fact that some of the companies that are minting money have gained so much value over the past 12 months that they're the ones, and I'm thinking of Morgan Stanley, they're the ones that people are getting nervous about. Are you on board with that? This idea that some of the high flyers, I'm thinking of NVIDIA, I'm thinking of Microsoft, maybe have gotten over their skis?
Well, perhaps a little, but that doesn't mean that it doesn't go on. As the economy slows, investors are going to be looking for a spot for businesses that they think are going to continue to do okay in this environment. And so I think part of the challenge was our risk on call, which started last July, was a great one. But really, most of the broadening of the rally happened in a couple of months, right? Small, mid, did 20% in 2 months, November and December, on expectations of rate cuts, and then it's been all concentrated. So the risk on rally should have been broader. Then when you get to a more defensive spot, you tend to get more higher quality. So yeah, they are perhaps a little bit elevated, but I think that's where investors camp out in a slowdown. That could persist. Ultimately, what ends up happening over the next couple of years is in a easing cycle with a normalization of the yield curve, you should broaden out. But in the near term, I think investors hunker down a bit and stay in those names.
So you're still a FOMO kind of guy just with respect to NVIDIA and Microsoft, not necessarily with the rest of the broadening out. Is that correct?
Well, I'm a FOMO kind of guy over the next 3 to 5 years. Absolutely.
Okay.
Again,
so not in the near term.
Yeah, the headline might be it turns a little bit bearish from where we've been. I mean, we were full risk on since July. As things slow and we wait for easing, we get a little bit more defensive. But again, over the next 3 to 5 years, peak tightening, peak rates, peak inflation favor stocks.
Some of these words that people use, like becoming cautious or being more risk-on, have different meanings depending on who the person is.
That's true.
And the idea of being cautious in the past has been going into long bonds, having more cash, and going into, say, dividend plays in the equity market. What's the new conservative position?
Yeah, so the way we think about it is, so if you take a 60-40 portfolio, when we're more risk on, that 40% fixed income is going to be far more credit. Credit tends to do well in more of a recovery, risk on type of environment. We would increase exposure to longer duration bonds, quality bonds. Quite frankly, you can get some very nice yields there these days. And I would be a little bit cautious about sitting out in money markets because those yields will ultimately be coming down. On the equity side, when you're more cautious, you reduce some of your exposure to international and you move into factors like quality and low volatility, and you reduce a little bit of your small cap exposure and go more large cap. So it's not wholesale changes. It's protecting some of the gains you've had in the portfolio and adding some protection in the fixed income market to a portfolio.
We had this debate yesterday about whether or not, as an investor, you can look through the noise of politics. Do you find potentially advantages ahead of November, opportunities, or do you think there's setbacks?
I look through the noise of politics. If you look back historically and you look at volatility in markets, it doesn't come because of elections. So if you look at October and November of election years, the only years that you see a meaningful increase in volatility are 2008. And that was clearly for other reasons than what was going on in politics. And if we have time for it, I like to tell investors 3 points on politics. The first one is, since 1957, when the S&P went live, every president has had a positive return over their administration except W and Nixon, because their terms ended in bad recessions, or they left office in bad recessions. Number two, Trump's portfolio, over Trump's term, S&P was up 60%. Where's Biden right now? 60%. So it didn't matter at all. And the third point I like to make is, if politics matters so much, then how did Obama and Reagan both have 200% advances in the market during their term? Right? They both had great starting points. You know, I could become president in a recession when the Fed's helping out and probably get a 200%.
Are you running? Because I think that's...
Anne-Marie told me I have zero chance. So
you could head to the convention in August and make a challenge if you want. I think some people might be thinking about that. There have been changes, though, over the last decade. 2016, November 16, we were talking about investment in infrastructure, the Trump trade. 2020, you saw what happened when we started to see signs of a blue sweep and the prospect of more fiscal stimulus coming down the pike. There have been changes, and we're starting to wonder whether there's going to be consequences for the bond market. For two presidents, two leaders that don't seem to be willing to do anything about the deficit in a big way anytime soon.
Yeah. Well, I mean, with regards to the changes, you know, if we do go back to that 2016 moment, it was the hope, I think, from a lot of voters that Trump could unlock growth, could unlock value, and you had very much the same market leadership you had under Obama. So we didn't change the economic environment as a result of simply electing a new president. I mean, they basically get a couple of things done. They don't get to have their whole agenda play out. Now, with regards to rates, I heard this a little bit a week or two ago. You would know better than me, but right, there was a quick move up in the 10-year Treasury rate a handful of days ago, and people were asking me, is this the bond vigilante? Are they finally here? There's nothing in the bond market that suggests the bond vigilantes are here. This is a bond market that's been moving very much on nominal growth expectations and expectations for the Fed. If the bond vigilantes were here, the U.S. dollar would not be as strong as it is. So no, it doesn't seem as if the bond market views this as a problem. And I've been saying for a long time, Jonathan, I don't think that this is going to be a problem. My clients think it's the biggest problem we have, the U.S. debt level.
Your job is to provide therapy.
Well, I've been doing this for 25 years, and the debt's increased by 7 times. What was it, 5 trillion to 35 trillion, and yet rates are at 4% and the dollar's strong. So, you know, it's the Alfred E. Newman, what me worry at this point, right? I mean, we're a very wealthy country. Total household net worth is 150 trillion in this country compared to 35 trillion in debt. So I'm not overly concerned about this.
Brian, it's good to see you.
You too.
Brian Levitt of Invesco. It's the latest. Congresswoman Mike Sherrill of New Jersey becoming the 9th House Democrat to call on President Biden to drop out of the race. Biden's campaign working to restore confidence in his candidacy and bolster support from progressive leaders around the country. Joining us now, I'm pleased to say, is the Democratic Congressman Jonathan Jackson of Illinois. Congressman, thank you for being with Bloomberg Surveillance this morning. I just want to share a quote of yours with our audience, which I think is going to imply where you stand. I think he's up to the grueling call of the presidential campaign season. A question I would have for you, Congressman, I think is a question that a lot of people in this country have too. It's not just about the 4 months ahead of us. It's the 4 years after that. What gives you the impression that he can handle not just the campaign for the next 4 months, but the 4.5 years of governing he'd still need to do?
Well, I think he's got a great team around him. I think his agenda is clear. His focus has been very precise. When I think of what the alternatives that we are confronting at the moment, it's about direction, it's about character. President Biden has been very robust on the campaign trail in the last week since that debate, if you will. And so I'm very excited for him. I think that he's got a very strong number 2 in Vice President Kamala Harris. And he was able to share with us as the CBC members on a private Zoom call. He was able to take our questions. And so I'm very excited. I'm very confident that he can go forward, and we'll go forward in a very robust manner.
If you think he has a strong number 2, and he's 81 years old, and the polls continuously show, not just post-debate, this has been an issue with the electorate for over a year, that they just think he is too old to continue, why not promote the number 2?
I think he has been promoting Vice President Harris, and so we don't know what the future holds. But I would tell you this, that they've been out on the campaign. This has been a scandal-free administration. He's been very focused. If you look at what the alternative is on the chaos, the confusion, the calamity, if you will, I think the press has not put it in the proper light. If you think at a person that's been convicted by a jury of their peers of sexual assault, you usually get a handle on your name being called a sexual offender, former president. But no, they've given him a pass on that. So character is on the battle. And I think the African-American community is very clear at what's at stake. We've gone in the wrong direction with the United States Supreme Court. If you will, we've had 116 justices in American history, roughly 12,510 representatives in the House of Representatives. We've had 46 presidents. But this non-elected group of people that sits on the United States Supreme Court is able to dictate law. I think we need to look at some sort of judicial reform in the future, that the power that they have and the corruption that they've displayed is unprecedented. So the Supreme Court is on the ballot for this election season as well. And I would trust President Joe Biden and Vice President Harris to make that decision and recommendation before the American people.
Congressman, I want to share you some new data we got this morning from the Cook Political Report. They said that Trump's currently is 47 to 44% lead, the most dramatic shift they've seen in this race. And David Wasserman, an analyst there, said, quote, Trump's current numbers among Black and Latino voters are incompatible with any plausible Democratic victory scenario. What does Joe Biden need to do to really shore up the Black and Latino communities?
Well, I think he has to continue to stay in front of the community and also share with them all the things that he's done and what's to be promised in the future. We know on the Sunday before the Tuesday election, most Democratic candidates find their way to the African-American church. There are some more gains that the African-American church certainly deserves in the African-American community. If you think about what President Biden has done, one thing that's huge, and there have been many things, is that this is the first time an African-American woman was even considered to go onto the nation's highest court in Ketanji Brown. And her opinions and her decisions, her character is very important for us to have there. What he's done on trying to put people on the judiciary has been very outstanding. We're now seeing the erosion of African-American wealth. We're looking at going towards 2050 where there'll be zero African-American wealth that's also being projected. If we can talk about peace and security in Ukraine and Israel and Gaza and Taiwan and talk about rebuilding plans, we can talk about rebuilding urban America. Those persons that have had the history of being the descendants of Americans that have been enslaved, that have faced redlining, that have faced all the worst of America that have been truly American since the founding of this nation have not had an economic plan that has been sustained and that has been implemented. Our cities don't have to look this drab and this dire. We can also pick up people in America. And once we do so, we will expand the market. I believe in America, I believe there's a lot more potential. When we saw the past of segregated athletic fields, once they were transformed into a level playing field, now we're proud of the NBA, proud of Major League Baseball, proud of all of these other endeavors. We can do that same with our economy. When people have equal access to capital, that has to be a major focus of the Biden administration. What are going to be the financial institutions created to have long-term sustainable growth and inclusivity in the American economy? That's a promise, that's a commitment that should be made to the African-American community. It'd be good for America, it'd be good for the world.
Congressman, I want to go back to what you were talking about at the outset, where you were saying that it's character on the ballot, is who you are going to elect as just a person, a candidate, and you're talking about Donald Trump. There are a number of polls that have shown that Kamala Harris or many other candidates would do better than Joe Biden across from the ballot, across from Donald Trump. Why are you still supporting Joe Biden if you think that he has a lesser chance than other potential Democratic contenders to win in an election that you're framing as quite important?
Well, I would say it this way. You're talking to someone that's in elected office, and anyone that's been in this position before, you understand critics come after doers. And so we don't look at all the opinion polls. Opinion polls will tell us we're wrong. Opinion polls will tell us that we can't win, and we've overcome many of those obstacles. We're in the position now of molding and shaping opinion, and that's where I stand on the side of. I appreciate those that have dissented. I disagree with them. I think it's healthy that we have debates. I would have liked to have seen a more rigorous primary debate schedule that gives other persons the opportunity to get on the stage, but here we are. We're about 4 weeks away from the Democratic Convention, and I think these different opinions and party persons that may disagree, I disagree with them, but I respect their opinion. I think in the end it all comes together. And so I don't want someone to be crowned the next president. If someone has a dissenting voice, I want them to be heard at the convention. Let's keep it open, let's keep the conversation robust, and let's take our case to the American people. This ultimately is decided not by the donors, but by a radical proposition, and that is that every person has a vote and it counts on Election Day. One person, one vote. And so this is where the billionaire class and the working class all have one voice, one vote on Election Day. So I follow opinion. Now it's time for us to shift opinion, not simply follow what the opinion polls are saying.
Congressman, I wish we had more time because we've got plenty of follow-ups to that particular last comment. Congressman, thank you. Congressman Jonathan Jackson there of Illinois joining us from Washington, D.C. Drew Pettit writing this: sentiment around stocks with high exposure to AI is the most elevated it has been since 2019. We advocate taking some gains in AI high flyers and redistributing more broadly across the theme's value chain. Drew joins us now for more. Drew, it's wonderful to have you with us on the program. Lots of people talking about your note in the last 24 hours. I think we have to draw a distinction, as you have done, between the AI enablers and perhaps the AI adopters. Can you help us work through your framework for thinking about equities at the moment?
Yeah, well, thanks for having me on this morning. So when we think of AI, we think of it in three pieces. The enablers, so the semiconductors, the picks and shovels. We get that. That's the trade that's really working. The creators, so the software side of things. After you have the hardware, you have to teach it to do something and package that in a product. And then I think the last category, it's the users. So you call them the adopters, we call them users. Those are the companies that are going to take those tools and either integrate it into their products to make it better or in their background processes to make their companies more efficient. So I think that whole value chain eventually benefits, but the market is just trading the enablers right now.
In part, Drew, because it's very hard to see where the money is. And we haven't seen it in the earnings for some of the end users. So why is this the right time, in your view, to make that shift?
You've just had that almost parabolic move in some of these high flyers. Like you see that with NVIDIA. TSMC overnight is up another 2%. So a lot of these names, with how aggressive they have moved, portfolio managers are overweight. So we're not saying dump these names, because to your point earlier, yeah, there's some career risk there if you're not in them. But if you're overweight, use that to fund the next leg. It will come. Markets don't stay on the same theme forever. And in some cases, I think the implied expectations with these enabler stock prices moving very far, very fast, get really hard to meet and exceed going forward.
You know, it's fascinating to me, Drew, because on the surface, your call sounded quite bearish, actually. The idea of it's time to liquidate some of the positions, it's time to take profits. It screams as, okay, get out of NVIDIA. And then you start listening to what you're actually saying, and it's actually incredibly bullish. It's that we haven't valued high enough some of the AI gains, and you could get better gains in other names that haven't made parabolic moves. How do you sort of reconcile that at a time when people are concerned about valuation, when people are concerned about a weakening growth picture? And frankly, there is that kind of uncertainty of whether we're actually seeing the profitability in some of these companies.
So to me, again, we're focusing on larger cap, already profitable stocks. But I hate to say this, but I don't really care about traditional valuation metrics. Don't talk to me about a 50 PE stock that's in the early innings of a new growth phase. What we do is we look at the market price today, make some assumptions about the discount rate and what the terminal value should be for the company, and we try to figure out what kind of growth rate do I need in the next 5 years to justify the stock. And some of these stocks do have expectations, like sell-side consensus expectations, that tell me they can meet what the market's pricing in. So that's why we don't think AI is a bubble yet. Yes, it's getting extended. Yes, price moves make you antsy. Yes, some of the options data makes you a little nervous. But really, there is a growth and fundamental story here. That's why it's not a bubble, at least not yet.
At least not yet. What would take us there then, Drew?
If you really don't see increased beats and raises from a lot of the AI pure plays, I think number one, you have to recognize when stocks move this fast, it's more than just good earnings. You need to change future expectations as well. And then if prices keep moving this way without fundamentals following them, that's the concern. That's what really got us in the tech bubble. I think that's the big difference from then to today.
Drew, I think we're all interested in just how clients received this call yesterday. Just trying to gauge sentiment. Did they push back? Did they engage with it? What was it like yesterday?
I was actually a little bit surprised that there wasn't more pushback. I think a lot of people actually were on the flip side. Like, I am getting nervous. I am worried that we are pricing in too much. So it was actually relatively well received. But on the flip side, I'm not sure people are ready to hedge. Again, that's not our base case, but we always have to recognize when we could be wrong, because markets make a lot of smart people look silly over time. And people weren't ready to consider the hedge or the complete other side of the trade. So there's still a lot of AI bulls out there, but they're cautious bulls.
Drew, appreciate the update. Really do. Thanks for making time for us this morning. Drew Pettit there of Citi.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.